Afternoon, everybody. My name is Jim Lynch. It's my privilege to serve as the Executive Director of ASA, and thank you for joining us for this retirement planning session. And I'm really pleased that Joel Craven is with us today. Joel is the owner of Astraeus Financial. Their whole focus is supporting educators with their insurance and financial needs. And Joel's been doing sessions like this for us for years, and our members have always taken a lot away and really enjoyed the sessions. So Joel, thank you so much for the time. Joel's gonna, kind of plan on presenting some information for about 45 minutes. Please, as you have questions, just put those in the chat. There's gonna be plenty of time at the end for Joel to answer questions, and Joel, I'll help kind of cue those up towards the end. So I'll keep an eye on the chat. So with no further ado, Joel, thanks for being here. We greatly appreciate it.
Thanks, Jim. I appreciate the introduction. As Jim said, I own Astraeus Financial, and we work with K through 12 educators throughout the state of Wisconsin. Primarily looking at retirement. We have insurance and some other things that we work with as well, but really on the retirement side and trying to help you guys think about what's next, unless you want to be principals for the rest of your lives. I don't know. Maybe there's somebody out here that wants to do that. So you tell me. But so we'll kind of go through a couple different things today, starting with the state pension, some of the things in terms of how that works. We'll go through a statement, how to read it, what some of the things mean there. Then we'll talk a little bit about Social Security and how that builds into a retirement income stream. And finally, then from an investment perspective, what are some of the things to consider as you're building the rest of your retirement picture? A couple things that we won't do today. This is not about selling anything. All right. This is informational only. If you happen to decide you want to work with our firm, that's fine. That happens on our own time if that's appropriate. But you would want to work with a professional, and I would encourage you to do so. There's a reason why I don't try to educate my own children. It wouldn't work out very well for them or me. So this happens to be my area of expertise. So like with anything, it's a good idea to have a professional help you with some of these things. So this isn't a sales session. This is informational only. The other thing is, it's a little difficult through Zoom. This might be more of a lecture question format. I like to keep things interactive though. So if you fire questions into the chat, if Jim sees it, and if it's applicable to what we're kind of going over, Jim, feel free to jump in with a question along the way if something keeps getting asked repeatedly as we look at. So
sounds good, Joel.
Couple things just in terms of my background. I graduated in 2002 from UW-Madison. My degree is in accounting and information systems. So I've been a numbers geek for a really long time. I started this practice about 18 years ago now. We manage about 250 million in assets for people just like yourself. So we've been doing this for quite a while, helping people not only get to retirement, but get through retirement. In terms of what we're looking at, I was just looking the other day, and I believe we're up to about 550 families now that have successfully entered and are living a solid retirement. So we're really pleased about being able to help people do that. So with that being said, we'll kind of jump in. Like I said, if you have questions, drop them into the chat and we'll go from there. So I'm going to share my screen with you here. And what you should see in front of you is something that you all would have gotten in the mail here in the last week or two, maybe three. This is the latest statement from ETF. This happens to be my wife's. She used to teach for 6 years before she decided to hang up teaching and be home with our kids. And so she's been doing that since. But one of the things I found helpful in the past as we've gone through this is just to go through the sections of this report and what they all mean and some things to look out for when you see this. Because I think our habit as we get some of these documents is to look at them, set them aside and say, okay, we'll deal with that later. But this is one that's really, really important. So when we think about the state pension, it will be your single largest asset when you retire. For many of you, the value is going to be somewhere between $500,000 and $750,000 in cash value at the time you retire. But when you look at how that pays out to you over your lifetime, we're looking at benefits of 1.5 to 2 million for somebody that lives to 90 years old kind of thing. So this is an incredibly important asset when it comes to your retirement. The good news about it is Wisconsin is a really, really, really strong pension. I believe it's the 16th or 17th largest pension in the world in terms of the fund size, and it's very, very well managed. They are 97% funded. They used to be 100% funded. They went down to 97 over the last little bit, but anytime you're above 95% on one of these pensions, you're in a really, really good place. So this pension is really strong and does a really good job for you. So, but as you look at this pension statement, the first section here is very simple. It's your earnings, and it should normally there would be 2 lines in here on something like this. They're going to have what your full year is, and then they're going to have the half year. Because again, these are all January 1st of 2022. So they're going to have the full year of the prior year, which ended in July of 2021, and then the half year from July to December of 2021 as you look at this. And when you look at the years of service column over here, that should be 1 for every year that you work, as long as you work the full-time schedule. If for some reason you worked an 80% schedule or something like that, it might be 0.8. But typically it's going to be a 1 for 1 as you look at it. The second section then is the total creditable service. So you can see in my wife's situation, she had worked total for a little over 7 years as we look at it. These two things here are really, really important. The earnings are something you just want to double check and make sure. It should be your base contract rate. And then sometimes there might be some extras if you have coaching or some of those other things that you do. But that's what you should be looking at there. In terms of the years of service, the 1 for 1, your total years of service, you should see that go up every year. Unfortunately, at this point, this is still a relatively manual reporting process. So this is where we find mistakes made. And in fact, one of the gentlemen that happened to be on this call last time, he reached out to me after we talked, and we found a mistake on his wife's pension statement. And they were able to get that corrected, and it turned into a pretty big deal for them in terms of years of service. I'd have to look back at the emails, but it was a chunk of years that she was able to get back. Unfortunately, typically there's a statute of limitations on being able to change this of 3 years. So if there is a mistake and you don't catch it in 3 years, technically they don't have to make the adjustment. Now, in many cases, I've seen them go beyond that and make adjustments for people. But technically they don't. So this is a really important section to pay attention to every year that you get it. It should go up 1 year of service. You want to make sure that it does that. The next section here talks about, this is just the employee required contributions. So if you think about how you guys fund the state pension, right? Half of the money comes in from your paycheck, half of it is matched by your districts, is typically what happens when we're looking at the state pension. And I believe this year, those numbers are 6.9% is the contribution, as well as the employer contribution as you look at it. When you look at that, or when that goes in, you're going to have the right, and you probably did this when you set this up and probably haven't changed it, or maybe you changed it a little bit along the way. You have the right to go into the core investing or the variable investing on this, and then you get your rate of return based on what you're in. Core investing is a system or a method where they put about 40% in bonds or in a more conservative investment, and about 60% in equities, a more aggressive investment. And then what they do is they look at that year's earnings and they average it with the previous 4 years. So you tend to get a more steady upward ride on something like that. Variable is just what it is. It's 100% equities. It's going to go up. It's going to go down. It's going to go sideways. The key thing here is if you are in variable and you retire with money in the variable side of this contract, your income flow in retirement will fluctuate with the market, and that can be substantial. So if I go back to 2008, our last known major market correction that we saw some people in variable with 25, 30% reductions in their income because they had a large exposure here. So that's a really critical component as you get closer to retirement, is how are you invested and how do we go about changing that? One of the things that's important on the state pension system is that any changes that are made to the pension are made one time per year on December 31st. So for example, we can cancel out of the variable participation if we want to. And there's a couple of ways to do that, and we can talk more about that if that's something of interest to any of you. But canceling out of it will happen on 12/31. So if we were to file paperwork today, they won't make those changes until December 31st. And as you can imagine, the market is going to do everything except for what we expect between now and December 31st. So we want to be really careful about how we do something like that. But that'll be really important once you get to retirement. Again, like I said, if it's variable, it'll fluctuate. If you're all in the core when you retire, that initial number that they give you, and we'll look at some of those payouts in a second, but that initial number that they give you, that becomes your floor. It can never go below that number, ever, for the rest of your life. It can go up from there. It can come back down based on how they deal with cost of living adjustments and or investment gains or losses, but it can never go below that initial floor that you build on the core side. In the variable, it's going to go everywhere. Okay, so those will be things that we'll want to look at as we consider it. At the top of the second page or on the back of the statement, if anybody's following along on their own statement, this talks about additional contributions. And the question I always get on this is, well, can I make additional contributions to the pension if it's so good? The answer is really no. What's happening here is you're actually making contributions into a 457 that sits alongside the pension. And basically you're letting them invest that money for you. At the end, then you'll have the right to either roll this out into an IRA if you choose to, or something like that, or you can turn it into an income stream. But it does not affect the underlying value of the pension in terms of what it's going to pay out. It simply is an annuity that they add on top of the pension that's calculated based on years of service and all those kinds of things as you look at it. So really, this is not something that gets added to it. In addition, back in 2010, when they changed things, when you put this money in, it is not tax deferred anymore. So this becomes a money that you put in after tax. The earnings on it would be taxed. The money that you put in would not be taxed when it comes back out to you. So it's a little different approach in terms of how that stuff gets added. Whether or not that's appropriate for you depends on a whole lot of other factors. But in many cases, there are better tax laws to use depending on your individual circumstances. The next section here is just the beneficiary designation. So this is just what would happen to this pension in the event that you were to pass away. And you see here, this is exactly what you shouldn't do. I was just looking at this today as we received it, and I've been preaching about this for 5 years, and I haven't made the change myself. So shame on me for that. This says automated recording began in 1988 if you submitted the designation prior, otherwise the standard sequence applies. So if you don't have somebody listed there, it will follow the standard sequence in the state of Wisconsin, which would be spouse, children, parents, siblings, and then to an estate. The issue when you do something like that is your spouse or your children or whomever this would go to would have to prove that they are that relation to you at the time that you passed away. And of course, typically if things have happened where you've passed away, people aren't really in a great frame of mind to do that. So it's better to list somebody specifically. And for anybody that hasn't done that, there's forms that we can get out to you in terms of beneficiary forms. In fact, I'm going to send out a packet of information at the end of this call, and I'll include the beneficiary form in there so you can fill it out. And I'm just going to make a note to myself that I have to do that myself, in fact, as we look at it. So, but yeah, you want to name somebody specifically because then it goes directly to them, no question, no problem, avoids probate, all of that kind of stuff. Section 6, the separation benefit. This is if you are not teaching or not working in education and decide to walk away and pull money out of the pension. You only get half of what's in there, or basically what you put in yourself. Whatever the school matched, you would not get at that point. So for anyone that leaves education early and goes to a second career or whatever it might be, typically you do not want to pull money out of this pension until you retire, because you're walking away from half of the pension as you look at it. It's a really, really expensive decision to do, to make. If you have pulled money out for any reason in the past under the separation benefit, there is a way to buy back those years of service as long as you are back working in education. And so that's something that I can discuss as needed. There's some various rules around that, but if that's ever happened, you absolutely need to do that because it is well worth it. In fact, I had one gentleman who pulled out about 15 years of service. He went back to the public education world, worked another 15 years, and we were able to buy back his entire 15 years, which allowed him to retire on time as opposed to having to wait until 65. So there's some things that can be done there if for some reason in your past you had to do that or had done that as a result of something happening in your world. So there's something to consider as you look at it. The death benefit is what your spouse or your beneficiaries would get in the event you passed away before you had started to collect the income stream on this. So when we look at active, this is what it would pay out in the event that you were working and you passed away while you were working or while you were in a covered position. In the case of my wife, for example, she's inactive. So if something were to happen to her, I would only get her portion as we look at this. Again, this is important from a planning perspective. If you have someone who leaves education prior to being able to turn on the pension prior to 55, and actually I have 2 of them this year that are leaving education at 53 to go do something else. And so this is one of the things that we're having to deal with for them from a planning standpoint is, hey, how do we make sure that your family's made whole if something happens in the next little bit? So there are some things that we can do in terms of that. Next, we're looking at how things are calculated, and we'll go through this in a little bit more detail. But first of all, when you retire, when you decide, hey, I want to start drawing on my pension, they're gonna calculate it 2 ways. They're gonna calculate your formula benefit option. They're gonna calculate your money purchase option. You will automatically get the better of the 2, period. Okay. The formula benefit option looks at your top 3 years, not your last 3 years. That's important for some administrators, depending on what your career trajectory looks like. I've seen some people that finish as an administrator, some people that work as an administrator go back to the classroom, a number of different things. But it'll take your top 3 years. They multiply that by your years of service, which is why that number is so important. And then they multiply it by an annuitization factor, which is 1.6% or 1.76% as you look at it. And that develops what your income flow looks like. The money purchase just takes the balance in the account and spreads it out over the rest of your life. And again, you get the greater of the 2. Okay. Now, typically when we're looking at those 2, the formula benefit is going to be the higher of the 2 if you have less than about 35 or 36 years of service. So for most of you, or for many people, they're looking at retiring with 30, 31 years of service. The formula benefit option is typically going to be the higher of the 2. The money purchase option normally comes into play like for somebody like my wife, where she's stopped working, the money purchase option is going to be better, or for someone who has greater than 35 or 36 years of service. In fact, I was looking at one yesterday. Gentleman has 40 years of service. He's actually going to get a raise to retire based on how the money purchase option works for him. But that's 40 years in the classroom. You guys tell me whether or not that's going to work for you. So, but that's what you're looking at there. Okay. On the bottom here, the retirement benefits projections. Take these with a grain of salt. What these are is these are assumptions made that, hey, you stopped working today and never worked again, and it hadn't earned anything, or it took this exact balance and projected out what it would be at that point. So those aren't really accurate numbers in terms of what you can expect to see from this pension as you look at it. Okay. So kind of having gone through that, let's step back and let's talk about what it means to actually leverage this pension and use it in retirement, and how that all comes to into fruition. So first of all, in terms of, I'm going to skip through this. I'm going to send out this presentation to you guys later. We've done a lot of this stuff already. I really want to get down to what the options are, but in terms of what's available or how this works from a retirement standpoint, You can retire from the pension and start drawing on it as early as 55. 57 and 30 years of service is considered a full pension, or age 65. Okay, so 57 and 30 years or age 65, it would be a non-reduced pension. If you take it at 55, you'll pay 0.4% penalty for every year prior to your 57th birthday. So if you do the math on that, if you were to retire right on your 55th birthday and take the pension at that point, you're going to be looking at about a 10% reduction in the payouts on your pension. So for somebody that's a principal in the in Wisconsin, excuse me, and let's say you're earning 100,000, when we look at a 10% reduction on what that pension might look like, which will be between 50 and 55,000 in a situation like that, you start looking at 10% on $50,000. That's $5,000, and do that over 30 years. It's real money really fast. Now, my job as an advisor, or any other advisor that you would work with, is not to tell you that you should or shouldn't do that. It's simply to say, hey, here's the value of that decision. Is that appropriate for you to make? And that'll be up to you. But the idea there is we want to quantify that so you understand, hey, that's the decision that's being made. And it could be exactly the right decision for you. It just depends on your circumstances as we look at it. When you get ready to do that, and starting at age 50, you can start to request this. You can start to request your retirement benefits estimate from the state of Wisconsin. And they'll send you out a they'll send you out a whole packet, but there's 2 pages in there that are your application for retirement. And you can start to see what their projections look like. And we run those all the time for people, but when it comes time, you want to get those official documents from the state pension. You're going to have 7 different options when you retire. Okay. The first 3 really are for your life only. So life only annuity is basically just what it says. It'll pay out for the rest of your life. If you start taking that benefit option and you pass away in the first year, it's done. Nobody else gets a penny. The pension keeps the rest of whatever you saved. Okay. So typically we're only using that in the event where somebody is single. There may be other reasons to use it. I haven't run across them very much. By the way, these projections here are looking at a high average 3 of $50,000 is what we're looking at here, just so you know. When I went back and I said that 100,000 example at 50,000, this pension is designed to pay out about 50 to 55% of your pre-retirement income. That's typically what it'll do. And then there's some reductions, as you can see, depending on what kind of option you choose. But that's about what you could expect from the pension if you work to 57 with 30 years. Okay. The life with 60 months certain, life with 180 months certain, all that's doing is it's going to pay out for the rest of your life. If you pass away in the first 60 months or the first 5 years or the first 180 months or the first 15 years, somebody of your choosing will get the remainder of those 5 or 15 years. That's all that will do. If you took life with 180 payments certain and you passed away in month 181, your beneficiary gets 0 at that point. So those, again, typically are used for somebody who's single, or sometimes if there's a terminal illness or something, we've used those in some of those cases. But that's a very personal and individualized decision based on your circumstances as we look at it. The bottom 4 then are just what they say, joint and survivor. So skipping down to the joint and survivor at 100%, just what it is. It will protect you and your spouse or whomever you list as your beneficiary on that for the rest of both of your lives. Now, the key there, as you look at it, what the assumption that's made in this example is that the annuitant or the retiree and the beneficiary are exactly the same age. If the person that is the beneficiary in the account is older than you, the gap between the life only annuity and the joint and survivor annuity will be smaller because they are planning it out over your joint life expectancy, which will be shorter if you're married to someone older or you have someone older as the beneficiary. If that person is younger, it will be larger. So instead of, like in this case, you can see it's 2127 for life only annuity. The joint survivor at 100 is 1912. So you're giving up, in this case, about $200. If we take that out to somebody making 100,000, that'll be about $400 difference a month. Now, if you think about what you're really doing there, you're buying life insurance, right? You're guaranteeing that this income stream outlives you for somebody else. So the theory out there is that, well, what if we took the life only annuity and then actually bought life insurance to make up the difference? Doesn't work very well. The reason is even for $400, when we talk about needing to protect a $2 million income flow, that's really, really challenging to do, especially when we talk about cost of living adjustments and some of those kinds of things. So these joint and survivor options are used a fair amount because they provide a whole lot of guarantees for a pretty inexpensive price as you look at it. The next option we can kind of look at there is the joint and survivor with 180 months guaranteed. What this does is it pays out to you and your beneficiary as long as either of you are living. But if you both pass away in the first 15 years, your beneficiaries, your tertiary beneficiaries will get the remainder of those 15 years of payments. Okay. From a cash flow perspective, you can see there's very minimal difference. So a fair amount of people choose this option. If you do the math on it, what this does is it makes sure that your family gets pretty much 100% of the cash balance in your pension in the event that you were to pass away early, you and your spouse or you and your primary beneficiary on this. So a lot of people will choose that just because it makes sure that their family is going to get 100% of what they work for. The other two here, the joint survivor 75, joint survivor with 25% reduction. Basically, this says it'll pay $19.61 or the full amount on the calculation to you as long as you're living, and then your beneficiary would get 75% of that. Joint and survivor with 25% reduction at first death, it would pay out $22,048 as long as both of you are alive, and then it would be reduced by 25% if one of you passed away, you or the beneficiary that you have listed on there. So those are the decisions that you're going to get to make on this. Now, you get to make that decision one time. There's a 6-month window in which you can change your mind on that. You'd have to pay back the previous one and then they can restart a new one. But after that 6 month, it's locked in. So this decision becomes a really, really important decision when we get to retirement. And there's the financial component to it, right? Which is just kind of looking at the numbers and saying cash flow wise, does this work? But then when you're looking at these joint survivor options and all the different choices, there's also a healthcare component to this and a family lifestyle component to this. There's a number of different things that come into play as we look at something like this. Okay. But again, when we look at your state pension, and I know I'm going through it really fast today because we have some truncated time. Normally when I do these in person, these are 2-hour sessions and people can ask questions and things, but we'll certainly do that here at the end. But when you're looking at your pension, it's designed to pay about 50 to 55% of your pre-retirement income if you're 57 years old with 30 years of service. It is funded exceptionally well. It is a good, solid pension that you have access to here. So that's kind of the first piece of your retirement picture as we look at this. Okay. The next piece we'll talk a little bit about is Social Security. And many of you would have seen statements that look like this. This is just a Social Security statement. Now, they have stopped sending these out in the mail. I think for people that are 62 and older, maybe they still receive those, but I believe there was a cutoff date and they said, hey, everybody else, we're just going to do it online. So to that point, if you have not gone out to ssa.gov, Social Security Administration, ssa.gov, and signed up for your account, you should absolutely do that. Okay. A couple reasons. One is you obviously get access to your statement if you ever need it for any reason. But secondly, in the event that there's any fraud on your Social Security record or anything like that, or somebody else's wages are being reported on your record or something like that, you want to know that before you go to apply for Social Security. Otherwise, you've got a massive mess on your hands. So this is something that is part of our, for my family, as part of our fraud detection homework that we do between running a credit report and looking at Social Security. We do that at least once a year to make sure that there's nothing crazy going on. So that's what we look at there. Now, Social Security is one of those fun things, and they've taken some of the really crazy language off of here. So it used to have a whole blurb about how, by 2031, this is only going to be able to pay 75 cents on the dollar, all that kind of stuff. We certainly know that Social Security has its challenges. The thing I would suggest that you consider when it comes to Social Security is we cannot eliminate it as a country. Right now, if we eliminated Social Security, we would put 50% of our population over the age of 65 on the street tomorrow, as this is they rely on this for 92%, or excuse me, 90% of their retirement income. 92% of all the people over age 65 rely on Social Security for at least 50% of their retirement income. So it cannot be eliminated. Not that there's been any real political will to do that, but it can't be eliminated. There are some things they can do to change it. But under the current rules, Social Security, you're allowed to collect it as early as 62 or as late as 70. Now, every year that you leave it, and you can see in this example, it's $2,200 at 62 and $4,000 at 70, it increases by 8%. So that's something that's really important to consider when you get to the age of 62. And the thing I would suggest to you from a retirement perspective is you want to think about Social Security less as a retirement decision. It's part of it, but it's more of a healthcare decision as we look at it. If we think about this waiting game here and where that 8% comes from, what they're saying is if you live out to their life expectancy, which is age 81, you will have collected exactly the same amount no matter when you started to collect Social Security. Okay, 62, 70, 62 and 2 months, whatever it is. Okay. So what that tells us is, financially speaking, if you're going to pass away after age 81, you should wait and collect it as late as possible. If you're going to pass away before 81, you should collect it as early as possible. So if you can tell me that, we can build one heck of a plan, right? But most of us don't know that. In fact, I would posit that all of us don't know that. So this becomes something that's really, really important to think about from a healthcare perspective. In addition, just to make it more complicated, this is something that you want to consider in conjunction with your spouses if you're married. And the reason being is that when somebody passes away, a surviving spouse gets the greater of the two Social Securities, not both. Therefore, on the higher of the two Social Security, the life expectancy is substantially longer than on the smaller of the two, because again, you're looking at a joint life expectancy as opposed to a single life expectancy. And the statistics are beginning to catch up to us on that. Today, the statistic is if a married couple reaches the age of 62 and they haven't killed each other yet, or harmed each other yet, whatever that might be, right? There's a greater than 50% chance that one of them will see the age of 92. So when we look at this and we think about this from a family perspective, the base strategy that makes sense a lot of times is to take the higher of the two and delay it as far as you possibly can. And then the smaller of the two, you would collect a little bit earlier to help with lifestyle choices and things like that. Of course, all of the financial theory in the world when it comes to doing this is useless if you need it to live on, right? So there's the cash flow component too in the budget side of things. Hey, do we really need to leverage this at 62 to provide a lifestyle that we want to have, or should we be waiting? So there's a lot of discussion we have with our clients when we look at how do we actually go about claiming Social Security. And it really all comes down to that, hey, how healthy are we? And what do things look like from that perspective? As a result, like I said, it becomes a healthcare decision. And we might make set up a strategy where we say, no, we're going to collect the higher of the two at 70 and the smaller of the two at 65. But if health changes at any point, that changes that whole strategy. So this is a decision that we look at with our clients every year once they reach age of 62 is to say, okay, has anything changed? Does it change our strategy? Do we need to adjust things? As we look at it, I see down here they talk about current law and changes to law. They bumped it out to 2035 now, and it'll pay 79% of the scheduled benefits. So changes are coming to this. When we've seen changes made in the past in terms of Social Security, they've always kind of bucketed age groups. So typically we've seen them say, hey, people within about 10 years of retirement or 10 years of collecting, no changes. People that are like 10 to 20 years out, here's a set of changes for them. And then people younger than that, there are significantly more changes as we look at some of that kind of stuff. On this statement, then, when you go down here, the next thing is your earnings record. You want to make sure that, for identity purposes, I blanked this out on this individuals, but you want to make sure that the earnings show up in here are on your W-2. They'll be in box 2, excuse me, of your W-2. You want to make sure that they match as you look at it. For anybody that's self-employed, they'll show up on Form SE on your tax return. But you want to make sure that this is inaccurate, and there's a lot less mistakes we ever see in here, but that's something that you want to just double check and make sure. When they're calculating Social Security, they look at 30 years of indexed numbers. So there's a whole lot of history. So each year that you earn a little bit more than the last, previous year falls off. In order to qualify for Social Security, you have to have worked 10 quarters in the system, 40 quarters in the system, or 10 years. So there's some things there, and this really applies, for example, if somebody taught in Illinois for a while and then comes up to Wisconsin or something like that, because Illinois, for the educators down there, the teachers down there don't pay into the Social Security system. They just pay into their pension. So there's some differences there. And if that applies to any individuals, I'm happy to have that conversation as to what that might look like. But that's just kind of a quick tour of Social Security as we look at it. Then the last kind of leg of your retirement picture is, oops, it's the wrong one, is how you invest yourself, right? And you guys have all probably heard about 403Bs and Roth IRAs and all these different things, and they all serve their purpose when we look at a situation for an individual. What we try to do in our practice, and what I would encourage all of you to do when working with your own advisor or whatever it might be, is anytime you invest dollars, you make 3 decisions, okay? The first decision that you're making is, what kind of tax environment am I going to be using? Is it the 403B? Is it the Roth IRA? Is it a non-qualified? What kind of taxation am I looking at here? Am I paying the taxes today? Am I paying them tomorrow? What does that all look like? The next choice you make is investment vehicle. Is it a mutual fund? Is it an annuity? Is it an individual stock? Is it in life insurance? There's a number of different ways that you can make investments. And each one, of course, has its pros and cons, and each one may or may not be appropriate for your situation. And then the last choice you make is, how am I going to approach the investment options that I have? Market choices. Of course, you can invest as aggressively as you want or conservatively as you want. And the nice thing about these decisions is you can mix and match them however you want, right? You can have a Roth mutual fund that's 100% in the stock market. You can have a Roth annuity that's 100% in fixed. You can do this any number of ways that you want to. What's appropriate or what makes sense depends on your individual situation. Now, what I'll tell you is, most people that do the job that I do will talk to you till they're blue in the face about all the market choices that you have. The reality is, we all invest in the same stock market, right? And or even fixed accounts to a large extent. So it's very hard for that to be a differential when you're talking to an advisor, per se, as you look at something like this, because the money ends up in a very similar spot. One of the rules, though, on that is that 90% of our wealth is built from proper diversification, meaning that we're not too allocated or too focused on any one sector of the economy, one sector of the market, whatever it might be. I would posit that that's the same for these other 2 places. All right. The thing we know is that, the tax environment changes. Those are laws. They change at the stroke of a pen. Investment vehicles change on a company's whim, and the market just changes because it does, right? And so, knowing that tomorrow, the only thing we know for real about it is that it's different, we want to build as many options in here, or build as many different tools into that toolbox, so that when it comes time to start pulling this money out and you make these decisions in reverse, you have the ability to pull levers to do a lot of different things, okay? So one of the common examples that comes up is, well, should I do a 403B or a Roth or something like that? And the reality, when we look at it, looks something like this. So this is just an example of somebody who had a bunch of different choices from a tax perspective. And we're looking at, oh, what did they do here? I think it was 20 years of money going in at $200, going into a CD, a non-qualified annuity, a 403B, a Roth IRA. And let's focus on these last two columns here, right? So on a 403B, which is an option typically for all of you, when you put the $200 in, you don't pay any taxes on it today. The full $200 a month goes in. And so if you do that for 2,400, 20 years, you'd have 84,000 in there. And then assuming a 6% rate of return, when we look at this, there'd be 276,000 in that account. On the Roth IRA, of course, when you put the money in, you've got to pay taxes up front. And if we use a 24% tax rate in this case, that's 152 actually getting invested. Well, you end up with 209,000. But at the end, when you go to pull it out, and the assumption here is that you've met all of the qualifying events to be able to do that, if our tax rate is 24%, when we pull the money out, we end up with exactly the same amount of money in either one of those options. The problem here, or the thing that we want to look at, is we've made a pretty major assumption. And that assumption is that our tax rate is the same in both cases. For educators in the state of Wisconsin, typically, based on how the pension works and how Social Security works, which again, if you recall, the pension is designed to pay about 50 to 55% of your retirement income. Social Security should pay somewhere between 10 and 15% of your pre-retirement income. So right there, you're already back to 75, 80% of your gross income if we've worked to full pensions and all that kind of stuff in many cases. And maybe that's enough, maybe that's not. We'll talk about that in a second. But when we look at that, most people that have saved, just based on that alone, you're typically going to be back in the same tax bracket you are as when you're working, right? Now, you might be in a smaller tax bracket if you have a spouse that is a high earner or something like that, or you might be in the same tax bracket, but typically where we see two teacher families or even two principal families, in some cases, you're back in that 22% tax bracket, which starts at 83,000 and ends at 137,000 of taxable income, or excuse me, 157,000 of taxable income. So there's quite a big range there. That's the 22% tax bracket. The next one up is 24, which is what we're seeing here. But you typically end up in the same tax bracket because of how the pension pays. So the question becomes, when we look at that, is where do we think taxes are going? Are they going to go up? Are they going to go down? Well, nobody really knows, but I will tell you in 2016, there was a major change in our tax brackets. The 22% tax bracket had been the 25% tax bracket prior to 2016. It cost our country $1.5 trillion to reduce our tax brackets in 2016. Whether or not that's sustainable, I'll let you guys decide. But I would posit that given the national debt going over 30 trillion, all those kinds of things. I mean, at some point, that bill has to be paid. One of the easiest ways for them to do that is to mess with the income tax rate. So the whole point of that is to say, when you look at this and you think about how taxes are going to affect your retirement, and we go back to looking at the decisions that we get to make when we invest $1, it's really, really important that we think that through. There are other reasons to invest dollars in different things, right? For example, on a Roth, you have the ability to access your cost basis. Anytime you want, no taxes, no penalties. So for somebody that's a little bit younger, that can be really attractive because it helps you build an emergency fund and or a kind of a midterm spending bucket if you choose to do so. So there's a number of different things in here. And these are things that if you're working with an advisor or you're looking at building out a plan, you want to make sure you consider on your plan as you work towards retirement and some of this kind of stuff. Okay. When we look at kind of developing this income stream and thinking about what this all means going towards retirement, there's varying ideas on how much you actually need for retirement. A lot of things we see now is that people need somewhere between 85 and 90% of their pre-retirement income when they retire. There's a couple things in retirement that you're not going to be paying, right? The Social Security tax, you don't pay that on your retirement assets. The state pension, You're not going to be paying that. Any money you're putting into retirement, you won't be paying those. So what that percentage needs to be for you, that's a very individual thing. That just depends on, excuse me, what your circumstance looks like, all that kind of stuff. And we can help develop projections, or an advisor can help develop projections around that as you look. But the way to back into that is to kind of look at, like I said, the pension being about 50 to 55% of income, Social Security being another 10 to 15%, probably closer to 10 realistically, with the changes that are possibly coming. If we think about that, that puts us at 60 to 65% of our pre-retirement income. So then we need to save that difference to get us to a full retirement where you can maintain the lifestyle that you're accustomed to. And so then it's just a math equation to back into that, and we can certainly do that as we look at it. But that's kind of the quick and dirty way of looking at some of this kind of thing when we look at building retirement. And again, on these webinars, I try to kind of consolidate the information. So there's a million other things that we can go over, but this gives you kind of a snapshot or a thumbnail on this. Of course, we do these sessions live at the middle school convention, middle and elementary school convention, and also at the high school convention. So if you want to come in a day early and ask questions, we can do that. But at this point, I'd stop and turn it over for questions that anybody has. This is always my favorite part, because like you guys always tell your students, right? If you have a question, chances are somebody else has it. So don't be shy. Obviously, if it's going to involve a whole lot of personal information, we'll probably look to talk about that some other time. And one of the things, when we send out the information, I'll include my contact information in there. You are all welcome to contact me and ask questions at your leisure as well. So if you're thinking about something, I know I've done that in the past, and I've had people contact me. And then again, if people decide to work with my firm to help with this, wonderful. If not, if you have somebody you trust, beautiful. The only thing I would tell you on that is find a professional that you can trust, find a professional that you can work with. It's important. You're making some pretty big decisions when it comes up to retirement here, and it's always helpful to have an objective point of view at the table. I'll share this story just real quick before I wrap up. I don't do my own personal financial planning. The reason I don't is because of what money represents, right? So if you guys think about it, what does it represent? It represents your future security. It represents your future freedom. It represents all those kinds of things. How many of those terms are financial? Zero. They're all emotional. I can't possibly be objective about my own money because of what it represents for my kids' college, what it represents for my wife's security. There's no possible way I can be objective. The reason you hire a professional is to have an objective voice at the table that can help you think about a number of different ways that you might accomplish the same things. So that being said, I'll open it up for questions. Fire away.
Thanks, Joel. We had a question on a refresher on the fundamentals of WRS. So it's the average of your highest 3 years, correct? Doesn't matter if your highest 3 years are your first 3 years in your career, middle 3 career, last 3 in your career, but it's the highest average of your highest.
Always the highest 3. Yes. Yep. Yeah. So, and that people's paths take them many different directions, right? So we have some people that wait until the last 3 years of their career to become an administrator and bump up their high 3. I have people that do that throughout their career, and then just at some point enough is enough and you do something different, and that's okay too. So but it's your high 3 that are going to count for that formula calculation.
Thank you, Joel.
Yep.
Other questions?
Thanks for the information, Joel. Rob, that December 31st date for changing from variable, you just touched on, hey, be cautious, be thinking about when, how different market changes. Can you elaborate just a little bit more on some of the factors that would play into that decision prior to retiring, when to apply for that change if one wishes from variable back to guaranteed?
Yeah, so when you look at section 8 on this statement, I should be sharing my screen with you now. Hopefully you guys can see that. Okay, perfect. There's this variable excess deficiency calculation out here. And you see on this statement for my wife, it's 0. And the reason it's 0 is that we've never put her into variable as we look at that, okay? This number, whatever this is, when you retire, if it's an excess, it's going to just simply get added on top of whatever your base pension is. If it's a deficiency, it'll get taken away, okay? So when you make that change, what happens is you lock in that excess or deficiency, which is a really, really big deal. If you think about what's happening in the stock market today, this may not be the year to make that switch. Now, even if you're at retirement, you can still make this switch once you're into retirement. So it's not the end of the world if you can't make it prior to retirement. So you can still make that switch in retirement, but you want to try to do it beforehand if you do. And last year, for example, we moved a lot of people out of the variable as we look at it, okay? All of that being said, when we look at it, if we're making changes throughout the year, normally you will get projections of what the state pension is probably going to see from an earnings perspective. Typically, you don't see the market move very much in November and December. It can, but you don't see it. So October and November, they put out some earnings stuff, and that's usually when you want to file that paperwork. And there's a form that the state pension has for how you can do that, and we'll kind of talk through that as we look at it. But the big thing is to see where you at from an excess deficiency standpoint, and that really helps to inform your decision along with where the market is currently performing. But normally you don't file that paperwork until October or November as we look at it. I think the largest one I saw was last year. Somebody had, I think it was like 117,000 or something that they had as an excess, which turned into a pretty sizable, about $400, $500 increase in the pension on an annual basis based on that. Now, that being said, when we go back and we actually look at core versus variable performance, if we go back to 2007, which is our last known market peak, and we look at the 10 years prior to that, the difference in investment return between core and variable was approximately 0.03%. So you take a ton of risk on the variable side for very little return. So our basic, and this is why you see my wife's all in core, our basic strategy is to say, hey, let's let this be our base of our retirement. It's a solid base to work with. We want to take risk. We can do that with our 403Bs, our Roth IRAs, some of our other assets. So for many individuals, it doesn't make sense necessarily to go into the variable at all. That being said, if you're there, it hasn't been a mistake. I promise you that. And there are ways back out of it. So it's just that we want to make sure that we do that. When you actually fill out that paperwork, there are 3 ways to cancel your variable participation. One is for future benefits only. So that would be, like, for example, if you know you're going to want to get out of the variable over the next few years, you probably want to exercise that option. And what that'll do is that'll just mean for anything going forward, they'll put it all in core. The second option you're going to have is an unconditional surrender. And what that means, if you exercise that on 12/31 of this year, they're moving it regardless of what happened. If you have a deficiency here of $200,000, too bad, they're moving it for you. So typically you don't want to do that unless you're absolutely sure. And when playing with the stock market, you never can be. So I would suggest you not use that option. The third option, and the one that we most commonly use, is the conditional surrender. What that says is they will only move it over on 12/31 if your pension benefit would be what it would have been had you never participated in the variable to begin with, or greater. Okay, so it provides some added protection in there for moving that over. But again, that's a decision that you want to actively make, and I would work with your advisor on that, or somebody who's very well versed on the pension, to be able to talk about, hey, how do we go about doing that? So, Rob, as we look at that, again, we come back to October, November. That's when you're going to want to make those kind of moves, file that paperwork, because you'll have a good idea of where you're at for the year and a good idea of what your excess deficiency might look like. Anything other than that, we're really guessing.
Thank you. Thank you very much.
Absolutely. Anyone else? Don't be shy. This is the best part.
Hi, Joel. I'm Shauna LaPlante. Thank you for all this information. I have a question. I'm thinking a little bit about the statement you made, thinking about like what will it take to maintain your lifestyle when you retire?
Yep.
You explained like what the state pension will sort of equate to Social Security. I currently have a 403B. So in theory, then would I want to consider like that percentage of like my salary now of what I should be contributing to my 403B? Does that make sense? I don't even know if my question makes sense.
Yeah,
But
so I think what you're driving at is, let's say you're putting 10% into the 403B. Is that going to equate to 10% of your income when you retire?
yeah, right.
And that really depends on when you started and how the investments have done, all that kind of stuff. So it's hard to say unequivocally. What we would suggest for an individual that has the state pension is, for somebody that's like 30 to 35, we would normally look at needing to save approximately 10% of gross income. If you started when you were 40 to 45, that number goes up to about 15%. And if you waited to start until 50, it needs to be closer to 20%. What those are targeting there, if you use kind of those broad figures, is we're targeting having about 85% of our pre-retirement income available to us in retirement. Okay. So those are kind of the rules of thumb that we use. And then, of course, if you're working with an advisor who can run projections and do some things, you can get much more nuanced in terms of what that looks like. And the 85% rule, 85 to 90% rule, right? I mean, that all depends on what your lifestyle looks like. So, for example, I have some clients that are fully funding Roth IRAs, 403Bs, the whole thing. I mean, they're putting away 50% of their paycheck right now. Well, they certainly don't need 80% in retirement. They might have it, but they don't need it because they're used to living on 50% of their paycheck. So it all depends. That's a very individual question, depends on the circumstances. But rules of thumb, in your 30s, do 10%, in your 40s, do 15%, in your 50s, do 20%, if you're started then. So,
okay, thank you. That's helpful. Appreciate it.
Awesome. There are a lot of other things on the state pension too, in terms of buying years of service and all kinds of things that can be done. So, for example, if anybody on this call worked for some time in a different state, you have the ability to buy some of those years in the state of Wisconsin. Whether or not that's appropriate, there's some calculations to be done there. I touched on the idea of, hey, if you pull money out of the pension, making sure you buy back those years. I mean, there's all kinds of things like that. Your pension is a really flexible animal when it comes to some of those things, and you want to make sure you take full advantage of it. So,
I have a question.
Yes.
So right along that same vein of buying back years. So I stayed home for a couple of years, with my children. So how do you go about buying back years?
So buying back years refers to if you actually pulled years out of the system. So if you didn't pull years out of the system, you wouldn't be able to do that. And then purchasing other governmental service, you had to work in a different governmental agency to be able to do that. So when you stayed home with your kids, unfortunately, there's not going to be a way to make those specific years up, other than if you wanted to work a couple extra years or something like that. Your kids thank you, though. I guarantee it. So
That's what they said. And when you think when you government agencies, give me a couple examples. Like seriously, like the government, like
So in the state of Wisconsin, everybody belongs to the same pension. So there's really not any governmental agency difference in the state of Wisconsin. However, if you went to work for the federal government for a few years, you potentially could use those years to buy into the state of Wisconsin system. Whether or not that makes sense, we'd have to look at. If you worked in Illinois or Minnesota or Michigan or California, wherever, that's other governmental service. If you were in the public sector, we can use those years to buy into the system. And I did that here a couple of years ago. I had a gentleman who had 8 years of service in the state of Arizona. We were able to bring that over to Wisconsin, and it allowed him to retire right on time, as opposed to having to work to 65. So for people that have those circumstances, those are definitely things you want to explore thoroughly. Sometimes it doesn't work, sometimes it does, but it's worth turning over that stone. So,
And another thing, substitute, if you were substitute teaching at some point, what about in public schools? Is that ever?
It depends on the different districts look at substitutes differently. Many schools at this point now have substitutes that are kind of long-term subs where they might be working a 30% schedule or 50% schedule. Those will count. If it's true substitute where you're in on a day and then out and then in on another day, a lot of those won't accrue any benefits. But it depends on the individual school district as to how they define who is someone that's covered and who is someone that's not covered.
Okay, great. Thank you. And then I have another one. I've heard that if you don't finish a whole semester, that you don't really get credit for a full semester. So like, for instance, if my birthday is in September and I want to retire in September, I will not get credit for that particular school year. Or does it mean just you have to work so many days in that particular semester?
Yeah, so basically they're looking at calendar days on that. So let's say your birthday is in September, you want to retire in September. If your contract runs from July 1st until June 30th, you'll get credit for the days you worked until you retired in September, but of course you won't get credit for the rest of the time in that year. So you'll get partial credit for that year.
Okay, great. Thank you.
Yeah, no problem.
All right, any other questions for Joel? Hey, Joel, thanks so much. This is always really, really helpful and really appreciate your time. And thanks everybody for joining us. We appreciate it.
Thank you very much. And like I had mentioned, we'll send out a packet of information. It'll have my contact information in there. It'll have the state pension stuff in there. And feel free to reach out if you have any individual questions. I'm more than happy to talk with anybody. So
Thanks, everybody. Thanks, Joel.
all right, take care. Thank you.